In the last class, we made a small introduction to accruals concept. Under accruals concept, we book revenues whenever they are earned, we book expenses whenever they are incurred. So we are not very much worried about cash transaction. If we go a little bit more detail on accruals principle, because it's very important, accruals principle manifests itself in two different ways. The first one is accruals. Here we have cash collection after revenues are earned, or we have cash payments after expenses are incurred. So basically, first we have the economic transaction, and then cash transaction comes. So what are some examples of accruals? Here is one. We have a firm providing service and earns $500 in November 2016, which is payable in April 2017. So what was the principle about accruals? First, economic transaction will happen, and that's exactly what is happening here. The firm works and earns $500, and then the cash transaction will come. And the cash transaction will come next year in April. So how are we gonna go ahead and book this transaction? First, firm works and earns $500. Therefore, on the income statement, we book a revenue of $500. Since firm is not able to collect cash yet, this $500 is also recorded as an accounts receivable. It's going to be receivable sometime in next year. Okay? And the year end comes, and as you might remember, when the year end comes, we close income statement and we transfer the balance on the income statement to the retained earnings. So if you look at the income statement, we have a revenue of $500. To close this, we book a negative $500 on income statement, and then we also put positive $500 on the retained earnings. And this way, we transfer the balance on the income statement to retained earnings. And at the end of year 2016, here are the balances. We have account receivable of $500, and we also have retained earnings of $500. Next year comes, the firm receives $500 in April 2017. So how are we going to book this? First, this is not the first year that the firm is in business. Therefore, there are some opening balances, which is the same as closing balance of last year. Account receivable $500 and retained earnings $500. When the firm receives cash, cash balance will go up by $500 and account receivable will be reduced by $500. And now we are ready to close these financial transactions for year 2017. At the end of year 2017, we have a cash balance of $500. We also have a retained earnings of $500. Here is another example. Again, we are talking about accruals. There is first economic transaction, and then cash transaction will come. Here we have a firm receiving a utility bill of $250 in December 2016, which is payable in January 2017. So how are we going to book this? First, the firm receives utility bill. Since these utility bills are some form of expenses, we are going to book an expense on the income statement as $250. But firm is not supposed to pay this money yet. Therefore, we create a liability called utility payable, which is $250. The year end comes. Therefore, we need to transfer the balance on the income statement to retained earnings. So income statement balance before this transaction is $250 expense. To close this, you put a $250 gain, and then you book a $250 expense on retained earnings. So at the end of year 2016, then here are the closing balances. We have a utility payable of $250, and we have a retained earnings of $250 expense. Next year comes, and it's now time to pay this utility bill. The firm pays the utility bill of $250 in January 2017. We have an opening balances, which are same as the closing balance of last year. Utility payable of $250, retained earnings $250 expense. The firm pays this $250, therefore cash goes down by $250, and at the same time we get rid of utility payable because it's paid. And at the end of year 2017, here are the closing balances. Cash minus $250 and retained earnings minus $250. We said accruals concept manifests itself in two different ways. The first one was accruals. Under accruals, first economic transaction and then cash transaction. The second version of accruals concept application is deferrals. Under deferrals, first cash transaction comes and then economic transaction comes. So what are some examples? We have a firm receiving $1,000 in October 2016 as an advance payment for a job to be delivered in December 2016. As you notice here, first we have the cash transaction, firm receives $1,000. And then firm is going to go deliver the service in December 2016. How are we going to book this? Well, first of all, firm gets $1,000. Therefore, cash balance will go up. Can we book this as a revenue? Not yet, because the firm didn't earn this money yet. We have to be very conservative to book this as a revenue. Therefore, until this money is earned, we are going to book this as an unearned revenue, which is a liability account. Under unearned revenue, we will see the amount paid by customers, which is not earned by the firm yet. Now, December 2016 comes, firm provides the service. Now, firm earns this $1,000. So how are we going to book this? First, we will get rid of the unearned revenue balance. And secondly, we are going to book $1,000 under income statement. The year end comes, we need to close all these financial transactions, and we need to transfer the balance on the income statement, retained earnings. So as you can see, the balance on the income statement, $1,000, is transferred to retained earnings. And here are closing balances at the end of year 2016. We have cash of $1,000. We also have retained earnings of $1,000. Let me show you one last example about deferrals. Here we have a firm. It pays $1,500 in January 2016 as an advance payment for the next 2 years' rent. So basically, for each year, the amount of rent is $750, and the firm pays $1,500 at the beginning of year 1 for the next 2 years' rent. How are we going to book this? Notice again that first we have cash transaction. Cash is already paid. And then we will need to book some revenues and expenses. First of all, we pay $1,500 as an advance payment. Therefore, there will be a reduction of $1,500 from cash. How are we going to book this? Is this an expense? Not yet. This is just advance payment. We are paying advance payment of rent for the next 2 years. We didn't use this building or facility yet. Therefore, it's not going to be expense right now. It's going to be expense over the next 2 years. Therefore, initially, we are going to call these advance payments as prepaid rent, $1,500. Notice that this is an asset. These are here under prepaid rent or prepaid accounts. We book advance payments. So year 1 ends. At the end of year 1, we use this building or facility for 1 year. Therefore, you need to recognize 1 year's rent expense. How are you going to do that? First of all, you book $750 as a rent expense on the income statement. And secondly, you reduce $750 from prepaid rent account on the balance sheet. Year end comes, you need to transfer the balance on the income statement to retained earnings. How are we going to do that? To transfer the balance on the income statement is minus $750. And notice that we put the gain of $750 on the income statement, and we also book $750 on retained earnings. And here are the closing balances. At the end of the first year, we have cash reduction of $1,500. We still have 1 year of unused prepaid rent, $750, and then we have under retained earnings $750 as an expense. Now it's a good time to practice what we learned. Your job is to look at the balance sheet of Walmart and to identify accruals and deferrals. So in particular, you are going to go through assets of the Walmart and liabilities of the Walmart and to find all deferrals as well as all accruals. Our job was to identify accruals and deferrals for the Walmart for year 2015. Here is the asset side of Walmart, and let's see whether we can identify any deferrals or accruals. The first thing that you need to notice here is prepaid expenses and other. The amount is $2,224. Here we see a form of deferrals. Basically, Walmart paid in advance for the rent of some of its superstores. The next thing that you should notice here is other assets and deferred charges. This is under long-term assets, and the amount is $5,671. So you need to look at the details on what exactly is included here. There are many things included here. This is a catch-all account, but the most important thing from our purposes is deferred charges, And under deferred charges, the most important thing that Walmart has is prepayment of some taxes in advance. How about liability side? Under liability side, we have three forms of accruals and deferrals. The first one is accrued liabilities of 19,152. Let me remind you one more time, all of these numbers are in millions. So basically, Walmart has accrued liabilities of 19 billion. So what is in here? There are many things here, but the most important one is wages. Basically, employees work for Walmart, they are not paid yet, and it is recorded as an accrued liability. The second one is accrued income taxes. The amount is 1,021. As you can understand from the name, here we have Walmart. It is supposed to pay tax to governmental authorities. They didn't pay it yet, therefore it is recorded as accrued income taxes. And similarly, we also have deferred income taxes and other of 8,805. This is the same as accrued income taxes, but notice that it is under long-term liabilities. So basically, Walmart is supposed to pay to government authorities at least 8,805 for its tax expenses.